Bitcoin's price has been on a wild ride lately, and today we're diving deep into why it lost over $100 billion in market cap in just a few hours. If you're wondering what's behind these crazy swings and how to make sense of it all, stick around. We're about to unpack the chaos piece by piece with a fresh take you won't find anywhere else. So March 11th, 2025, the headline screamed, Bitcoin plunges. The price? Hovering around $81,728. But it wasn't long before it dipped below that psychological $80,000 mark. Ouch. Now, daily fluctuations are nothing new in the crypto space. We've seen it all before, right? But this felt different. This felt significant. The Fear and Greed Index plummeted to levels we hadn't seen since mid-2023, signaling widespread anxiety amongst investors. But what was the catalyst? What sent the market into a tailspin? Well, let's peel back the layers of this digital onion. Several factors converged to create the perfect storm. First, and perhaps most obvious, was market sentiment. Once Bitcoin breached that $80,000 threshold, panic selling kicked in. Think of it like a snowball rolling downhill, gaining momentum and size with every rotation. Investors, spooked by the initial drop, started dumping their holdings, further driving down the price. Fear is a powerful motivator, folks, and it was on full display that day. But the story doesn't end there. Politics also played a role, albeit a somewhat nuanced one. Remember President Trump's announcement about establishing a strategic Bitcoin reserve? You'd think that would be bullish news, right? A major endorsement from a world leader. However, the market reaction was muted at best. Some analysts argued that investors were wary of the potential for unpredictable policies from the Trump administration, particularly the lack of a concrete plan for the government to actually buy more Bitcoin. The devil, as always, is in the details. And then we have the broader economic context. Bitcoin doesn't exist in a vacuum. It's increasingly correlated with traditional financial markets, particularly the stock market. On the same day Bitcoin tanked, the Nasdaq and S&P 500 also took a beating. Concerns about a potential economic recession and ongoing trade tensions between the US and China added to the overall sense of uncertainty, further pressuring Bitcoin's price. It was a classic case of risk-off sentiment gripping the market, and Bitcoin, being a relatively high-risk asset, suffered the consequences. Okay, so we've identified some of the reasons why Bitcoin crashed. But can we actually predict these kinds of movements? Is there a way to anticipate the next big dip? Well, buckle up, because predicting the future in crypto is like trying to herd cats on roller skates. It's messy, unpredictable, and you're probably going to fall down a few times. However, by understanding the key factors that influence Bitcoin's price, we can at least improve our odds. Let's look at the main ingredients. First, monetary policy. Keep a close eye on what the Fed is doing with interest rates. High interest rates generally make riskier assets like Bitcoin less attractive, as investors can get a decent return from safer investments. Any shift in the Fed's stance can send ripples through the crypto market. Then, we have geopolitical tensions. Trade wars, political instability, anything that creates uncertainty in the global economy can negatively impact Bitcoin. Investors tend to flock to safe haven assets like gold during times of turmoil, and Bitcoin, despite its digital gold narrative, often gets caught in the crossfire. Of course, we can't forget about the halving events. These pre-programmed events, which happen roughly every 4 years, reduce the reward miners receive for validating transactions, effectively cutting the supply of new Bitcoin in half. Historically, halvings have been followed by significant price increases as scarcity drives up demand. However, the immediate impact can be volatile as the market tries to adjust to the new supply dynamics. It's important to remember that past performance is not necessarily indicative of future results. Then there's market sentiment. This is the wild card, the unpredictable human element that can amplify both gains and losses. Positive news, like institutional adoption or regulatory clarity, can fuel bullish sentiment and drive prices higher. Negative news, like security breaches or regulatory crackdowns, can trigger panic selling and send prices plummeting. Staying informed and understanding the prevailing mood in the market is crucial. And finally, follow the money. Keep an eye on the flows into and out of Bitcoin ETFs. A surge in inflows suggests strong institutional demand, which is generally bullish. Conversely, a sustained period of outflows can put downward pressure on prices. Tracking these flows can provide valuable insights into the overall health of the Bitcoin market. Now, let's talk about the Bitcoin halving. Why does cutting the reward for miners in half cause so much excitement and price speculation? The halving reduces the rate at which new Bitcoin enters circulation. This hard-coded scarcity is a key part of Bitcoin's value proposition. Think of it like this. If the supply of something decreases while demand stays the same or increases, the price is likely to go up. That's basic economics. Beyond the pure economics, the halving also has a psychological impact. It's a reminder of Bitcoin's limited supply and its decentralized nature. It reinforces the narrative of Bitcoin as a hedge against inflation and government control. This can generate excitement and anticipation in the market, leading to increased buying pressure. Historically, halvings have been followed by significant price increases. However, the magnitude and timing of these increases have varied. There's no guarantee that the next halving will produce the same results. The market is constantly evolving, and new factors can come into play. Finally, the halving affects Bitcoin miners. When their rewards are cut in half, they face increased financial pressure. Some smaller, less efficient miners may be forced to shut down, reducing the overall hash rate of the network. This can create concerns about network security, although the Bitcoin network is designed to adjust to changes in hash rate. So, there you have it, a deep dive into the Bitcoin roller coaster of March 11th, 2025, and a look at the factors that influence its price. Remember, investing in Bitcoin is inherently risky. Do your own research, understand the risks involved, and never invest more than you can afford to lose. The crypto world is full of opportunities, but it's also full of pitfalls. Stay informed, stay cautious, and good luck out there.
If you enjoy this video, please like, share, subscribe, and hit the bell to the latest update from my channel. Thank you for watching till the end, and see you in the next video.